So this is part of our financial process every year. We engage a law firm or an accounting firm to go through our books and perform an audit. And they do that as per the GASB standards. And that may be why some of the language for some of us lay people like me that did not go to school per se in depth for accounting. It can be a little much, but we did invite one of the heads of the accounting firm that we use, Mr. Tatana, Dave Tatana, to go through these materials with us. So I think in the interest of time, I'll let Dave start into his presentation, but I'm sure there'll be times where we may have to have some clarifications, terms or concepts clarified, which is perfectly okay. Don't be afraid, to ask what something means if you're not sure. Okay, thank you.
Thank you very much. In front of each of you is what we refer to as a graph analysis. This is this document. I think we're going to get it up on the screen as well. This kind of gives you a highlight of the 2022-23 audit. Okay. I believe on the board site there's an actual draft copy of the independent audit. This is really the document that I'm here to present. The graph analysis is nice because we've provided some high-level information on the document itself, along with some historical perspective, some of the numbers where they were 5 years ago compared to where they are currently. So I think it, gives you a little bit of perspective of where were we, where are we currently from a financial perspective. Okay. Ultimately, why I'm here is because this document, which is your financial statements of the district, presents the financial position and the results of operations for the 2022-23 year. Okay? Our job is to basically obtain evidence, obtain documentation, and ultimately to provide the district an opinion. And the opinion is really twofold. One, there's a lot of numbers that are included in this document. And again, that's your balance sheet, your assets, liabilities, your equity, your revenue and expenditures. Along with all the numbers, there's a significant amount of disclosures. And the disclosures really represent how things are accounted for. They also provide supplemental information on, background information as far as some of your assets and liabilities and equity. And our job is, again, to go through the documentation, obtain evidence, and ultimately provide an opinion. And the opinion is whether or not the numbers and the disclosures are fairly presented in all material respects in accordance with generally accepted accounting principles. Okay. I'm pleased to report that we're providing an unmodified, clean opinion, which basically says, yes, these financial statements are in accordance with those standards. Okay. Ultimately, this document is utilized by many entities. First and foremost, it ultimately gets published on what's called the single audit website, where all of the departments in the federal government that provides the district funding have the opportunity to review this document. Okay. during the course of our audit, we're not providing a forensic audit, we're not providing an internal audit, but we do obtain a lot of documentation throughout the course of the audit. And if there are circumstances that we consider to be a weakness in your control structure, or if we see where you did not comply with laws or regulations overall, we're required to outline that within this document, okay? And then lastly, there's one more report that we provide. And again, that's a report on internal controls and compliance with laws and regulations. The difference with this one is that it's very specific related to the district's federal awards. You receive more than $750,000 of federal awards on a given year. And as a result of that, we're required to do what's called a single audit, or an audit in accordance with uniform guidance, okay? Under that audit, we are actually providing an opinion, and that opinion basically says, are you complying with the specific federal guidelines that relate to the programs that we're testing under the single audit. And this year we tested 2 programs, your ESSER pandemic-related funding, and also the cafeteria, which receives federal subsidy from the Department of Agriculture, okay? So we really perform a second subset of the audit where we're really looking at documentation. Some of it's programmatic and some of it's financial, but we're ultimately determining, are you complying with the laws and regulations as prescribed by the federal government for those federal programs, okay? So in a nutshell, how did we do? Overall, we have one internal control weakness. It's a weakness that we've reported on in the past. We'll probably continue to report it on the future, and that is that we provide assistance in helping you basically put this 60-page document together. How do we do that? Twofold. Number one, we provide some assistance in journal entries where we, provide some entries that maybe increase your assets or decrease your assets, help you record things on a long-term basis, and then also help you with the disclosures that are included within this document, okay? As far as compliance, both overall and with regards to the single audit, we had no items to bring to your attention that we identified as an area of non-compliance, okay? So the single audit is what's referred to as an unmodified opinion, clean opinion with regards to the single audit. So congratulations. That's what you want to hear. Okay? Any questions on the main reports of the financial statements? Okay? All right. So the next section of the audit, I'll kind of work through the graphs. And this is more the financial section, okay? As Ken mentioned, GASB. Well, what is GASB? GASB is the Governmental Accounting Standard Board that basically sets how things are supposed to be recorded for governments, including school districts. And when you're a school district throughout the United States, you actually report your financial information in 2 ways. Number one, you present it on a long-term basis where you show the district's not only cash and receivables, but also primarily the investment that we've made in our school buildings and any equipment that we've purchased. Okay, so short-term and long-term. From a liability perspective, the reporting model says we also have to present long-term liabilities and short-term liabilities and show our district-wide obligations of the district. So that's one model, and we're going to go through that a little bit. The second model is all governments and school districts have to report on a short-term basis, where things like your investment in your fixed assets and your general long-term debt is actually not reported, okay? Previous to a standard, it was called Standard 34, school districts really just had to report their short-term activity. And GASB 34 was the pronouncement that basically said, we want to see school districts and governments similar to a business on a long-term perspective, okay? And ever since GASB 34, there's been other pronouncements that have added to some of the financial information that you're reporting on a long-term basis. And I'll go through a few of those. So your first two schedules, GASB 34, long-term perspective, you'll see the assets of the district, liabilities, and then net position. And you'll notice the district's net position is actually a negative net position or an overall deficit, okay? So a couple things. Actually, if you want to flip back to page 7. So page 7, you can see for the most part our assets in the blue versus the purple, pretty comparable. We had a pretty significant decline in our liabilities, and our net position really over the last 5 years has improved each and every year, but it continues to be the negative, okay? So why are we in a negative position? Basically, probably about 7 years ago, the GASB basically said all school districts and all governments throughout the country, you have to report your proportion of any pension system that you belong to. If it's a overfunded plan, you get the opportunity to represent an asset. If the plan is underfunded, you have to show your share of that underfunding, which actually gets represented as a liability, okay? In the state of Pennsylvania, school districts are in what's called the PSERS pension system, and that system for this reporting period was funded at about 61%, which means it was about 29% underfunded, 39% underfunded, okay? So that 39% we had to show is a liability for our share of that underfunding. And every single school district throughout the state had to do the same. If we were a larger school district, it was a bigger liability. Smaller school district, smaller liability. Basically, it's our proportion. So Wattsburg Area School District represented about a $29 million liability on your financial statements, okay? That actually increased about $1 million from where it was in the prior year. Why did that go up? It was really a result of the market. The market, this is actually valued as of June of 2022, declined in 2022. As a result, everybody's liability increased from where it was in the previous year. Okay? So really the pension has a pretty significant impact on the long-term financial statements of school districts. Okay? Another liability that's represented is what's referred to as the other post-employment benefits. And that's basically the district providing health insurance for retirees when they retire, okay? And there's really two components to that. One, the PSERS plan has a small benefit related to health insurance that employees receive when they retire. Very small. However, they quantify that and it gets represented in your financial statements. That was about $1 million as of June of 23. The other amount of the liability is the district's plan. The district has some benefit for some retirees. And that total liability is about $2.2 million. So in total, the district's other post-employment benefit liability is about $3 million. Okay. Last year.
That's based on our current employees.
Yep.
If everyone were to retire tomorrow, what would our liability be?
Correct. It's what's been earned. So it's not what's going to be earned. And the same with the pension system. Ultimately, that liability of $29 million and the 61% funding of the PSERS, what they do is annually, PSERS has an actuarial study performed. And the actuarial study basically says what's been earned by the retirees and the employees for the state of Pennsylvania. The retirees, they have earned 100% of their benefit. So it's a pretty easy calculation by the actuaries. How long are those retirees going to live? And we kind of know what the benefit that they're going to receive. So that's one piece of the obligation. The second piece is our current existing pool. And for those employees that have been in the state education system for a long time, they've earned a good percentage of that, of their benefit. So that gets quantified as a liability. For a very new employee, they've earned very little of their benefit. And so there's very little obligation for a new employee, okay? So that whole benefit gets added up and say, what's the obligation that we currently are indebted to our employees and retirees as of right now, and then how much is in the pension system right now, okay? Is it overfunded, underfunded? Currently 61% funded. Okay. Any questions? Let's go to the next page. Next page represents the district's expenses, program revenue, general revenue, and change in that position on a long-term basis. And the reason why I say long-term basis is because included in expenses is things like depreciation. So annually, when Vicki comes to the board and says, I want to adopt a budget, the budget doesn't include depreciation, okay? Because that's on the short-term model. For financial reporting on a long-term model, included in your expenses is depreciation, okay? Also included on a long-term model is pension expense that's calculated by the actuaries. So it's not the contribution that the district makes annually, it's what the actuaries say is pension expense, the amount that's been earned by the employees, okay? And so for the current year, you'll notice your expenditures were up. They were up about $850,000, which is about a 3% increase in expenses overall, district-wide, long-term basis. But again, one of the things that I want to bring to your attention is about half of that increase is just really pension reporting. Because the liability went up, the total plan was a little bit more underfunded this year than it was last year. Total pension expense was actually up about $400,000 in 2023 versus 22. Okay, even though your contribution, the amount that we're paying for our existing employees, was pretty comparable in 23 versus 22. Not a lot of change. Okay, but it affects long-term reporting. Okay, and then lastly, as I mentioned on the previous page, from a long-term perspective, the district's been doing pretty well the last 5 years. You can see each of the last 5 years, you've had positive experience in your changes in that position. Okay? Let's go to the next graph. And the next section of graphs represents the general fund. This is the main operations of the district. Okay? So again, every board meeting, annually when we approve a budget, we're really approving and we're looking at information on a short-term basis. And the general fund, we're going to see some graphs on your cafeteria, more on a short-term basis. Okay, how are we doing on a short-term basis? You can see our assets, pretty comparable. Liabilities were up just a little bit, and our fund equity was, again, pretty comparable, really the last 4 years. In the current year, we had a decline in our total fund equity, just under $400,000. And we'll go through why did that change this year versus last year. Okay, page 11. There's a component of your assets. Again, in total, didn't change significantly. Your cash was up a little bit, and due from governments was down a little bit. Due from governments, a lot of that is related to this pandemic funding, okay, and the timing of when you're receiving the pandemic funding. Page 12 represents the district's liabilities, which was up overall. You can see where most of the increase was was in the area of accounts payable, and then due to other funds. The accounts payable was up due to the fact that you had an existing maintenance operation type contract that was ongoing over the summer. That was your window project, hot water project, and there were some amounts that were due to your contractor at the end of the year. Due to other funds, that's just amounts due to the capital project fund and due to the, when the transfers are made with respect to the approvals that the board has made with respect to your transfers from the general fund to the capital project fund. So really just timing. Everything else was pretty comparable this year versus last year. So page 13 represents the district's equity. Again, in total, it was down approximately just under $400,000. You can see you have really two buckets: committed fund balance, unassigned fund balance. Okay? Committed fund balance, that's the fund balance that the Board of Education has set aside specifically for capital improvements. And really what you've done is you've set the money aside, and then every board meeting or every so often during the course of the year, you've had approvals to say, we want to utilize some of the funds that we have set aside for capital purposes. And you have specific resolutions to say, let's make a transfer from this committed fund balance for capital and transfer it over to our capital project for a specific project. Okay, and you do that routinely throughout the year. We did a lot of auditing to make sure, those transfers and use of your committed fund balance were approved by the Board of Education, and they all were. So that was excellent. I can tell you, some schools will have that category called designated for subsequent years expenditures. And you might ask, what is that? Well, that's when school districts are utilizing fund balance to actually balance their operating budget. They are using fund balance to do that. And so they really don't have a balanced budget. In order to have a balanced budget, they're saying we need to utilize fund balance. The fact that you're not utilizing any of your fund balance to balance your budget goes to the strength of your budget, at least the last so many years. School districts that have use of fund balance, they're not operating in the black. They're estimating that they're going to lose money, and they're going to backfill that with some of the fund balance that they've accumulated over the years. Okay? So it's never a bad thing to have zero unassigned fund balance. Okay? And then lastly, unassigned fund balance, you'll notice that went up. And that's just due to the fact that you used more committed fund balance during the current year than the amount of fund balance that you used overall. Okay. Any questions related to fund equity? All right. Next page, revenue. You'll see your current year revenue, $29.3 million compared to just under $28 million. That was an increase of about 5% in 2022-23, so a nice increase in revenue. And page 15 shows your components of revenue. Really pretty comparable, local sources, state sources, almost 50-50 of where your total revenue comes from. Had an increase in local sources. Your taxes were up about 3%. You also had an increase in your earned income tax and transfer taxes, which really fueled the increase in your local sources. And then state sources, the state provided us a pretty nice bump in our basic education subsidy in 2022-23. Okay, that was up about $500,000 in 22-23 versus the prior year. So overall, increased 5%. You'll notice the federal sources where we had funding the last 3 years, and prior to 3 years, we had not very much in federal subsidy. Okay, what created that increase? The pandemic. Okay, and I'm going to go through towards the end, a little bit about where you are in your pandemic funding and your expenditures related to that funding. Okay? Yes.
Can you give us an example of other sources?
Other sources, good question. In the current year, your other sources was actually you entered into a lease for technology equipment. And under the GASB standards, when you enter into a lease, basically the proceeds from the lease that you are receiving from the leasing company gets represented as other sources called proceeds from a lease. And then the expense related to the lease is categorized as an expense. That's one possibility for other sources. I've seen schools have bond refundings where they actually issue new debt to pay off their old debt. That would be an other source. But for your specific situation, it was really related to leases.
So technically, we did not receive
Yeah.
that amount of revenue. We just received the value of the technology that we purchased. And
That were borrowed.
that we're
Exactly.
paying, 3 years. So we have a 3-year cycle, so we paid $93,000 this year, we'll pay $93,000 next year, we'll pay $93,000 the following year, then we turn the equipment in, and we get all new, and we start the cycle all over again.
Is it valued at more than 93,000? Is that the difference?
No, it's kind of, it's kind of a little bit odd how it gets recorded. Yeah, it's confusing. You actually, in the first year that you issue or enter into a lease, you record basically the 3 years of payments, and it's discounted a little bit. So it's basically you're showing $300,000 of other sources, and you actually show $300,000 of expense. It's called technology expense. So the net effect on your bottom line is 0. And then each of the next 3 years, you're making payments, and those payments are also going to be reported as expense.
So we're adding to this column the table.
Correct. Yep. Okay, good question. All right, expenditures, which are on page 16. You'll see our expenditures were up about $2 million, which represents about a 7% increase. And if we look at the next page, we'll see our expenditure model. Instruction, pretty comparable. Not much of a change in 2023 versus 22. Really, your increase was in the area of support services. And there are really 3 main drivers of support services. One, transportation, your transportation contracts. I think you had additional runs, and then just the cost of living increase contributed to your increase in transportation. The technology lease, again, that was new. That was $300,000 that gets reported as an expense. And then lastly, the operation and maintenance. You had the water and window project, which contributed to expenses included in the operation and maintenance.
And all 3 of those items, the transportation was up because we ran a summer school program this past summer that was funded by ESSER money. So we hadn't done that in the past, so that was an additional expense, even though it was funded by an additional revenue stream. The other thing that you mentioned was the water project and domestic hot water. That was also partially government funded. So those increases in support services, while it's shown that it's a large increase, it was not money that was additional to the taxpayers. It was given by the federal government. That makes sense.
Nope, all good. Lastly, operating transfers out. I'll talk a little bit about that on the next page, but included in the operating transfers out are 2 items. One, our transfer to the debt service fund to make our debt service payments on an annual basis. And then also our transfers from the general fund to the capital project fund to make payments towards our improvements, which again are approved by the Board of Education. Okay, so if we look at page 18, this is a really nice schedule. This represents the revenue and expenditures of the district the last 5 years. The blue being revenue, the pink or red being expenditures. And I think when you look at this page, you can see really, with the exception of 2020, your revenue and expenditures are basically on top of one another, which for the most part, given the size of the district, you're more or less breaking even. You know, the revenue that you're bringing in, you're expending. I should note, though, each and every year, you know, we're making, with the exception of 2019, in 2021, 22, 23, we're making transfers from our general fund to the capital project fund to, again, make enhancements to the district's infrastructure. Some of that funding was funding that you're receiving, and then, again, some of that funding was the equity that we've built up in the general fund. And so in 2020, where that red was above the blue, you made a transfer of like 3.3 million from the general fund to the capital projects. In 2021, it was about 1.5. 2022 was 1.2, and 2023 it was 1.4. So the last 3 years, you know, right around 1.2 to 1.5 million. If you take those out of the equation, you know, you're operating at a surplus from operations to the tune of $1 million to $2 million over that period of time. Okay. All right. So the next group of slides that I want to cover, and I'm not going to go through this line by line, is the district's cafeteria. Starting on page 21, this gives you a nice analysis of the district's assets, liabilities, and net position. And you can see really the last 3 years have been incredible as far as the district's finances in the cafeteria. Prior to that, your equity was kind of stable, didn't change much. And then you can see, wow, the last 3 years, you've had substantial increases. Okay, so what's happened? Again, a lot of this is driven by the pandemic. If you turn to page 22, you can see, you know, starting in 2021, our revenue went up substantially. Okay, so what happened? Well, during the pandemic, the federal government wanted to provide relief to families, and as a result, they basically said all students are going to be eligible to receive free lunches and breakfast. And in addition to that, we're also going to provide subsidy for those lunches and breakfasts. So for every meal that the district serves, we're actually going to reimburse you at the federal rate for both lunch and breakfast substantially. And so that's really what happened in 2021 and 22. Okay, so all students received a free lunch and a free breakfast if they wished, and that free lunch and free breakfast was reimbursed back to the district 100%. Okay, fast forward to 2023, all school districts had to revert back to something other than the pandemic-related funding. Okay, some school districts reverted back to just the traditional model, where lunches were either free, reduced, and paid. And some school districts reverted back to what's called the community eligibility, where students receive free meals, but the reimbursement by the federal government wasn't necessarily 100%. Okay? At Wattsburg, we actually reverted to both models. Our elementary program was under the community eligibility program, so all students were eligible to receive free meals. However, we did not receive 100% reimbursement. And then the middle school and high school were all either paid, reduced, or free. Okay? And so under those models, the reimbursement wasn't as favorable as it was under 2022 and 2021, where we received 100% of our meals served. However, If you look at page 23, you still were able to maintain a level of revenue that was pretty comparable to where it was in 2022. Your federal sources were down significantly. However, your sales were up significantly and state sources were up. And the state sources were up a lot due to the fact that the breakfast program was reimbursed 100%. Okay? So a lot of school districts, I can tell you, we saw a decline in revenue, some very substantial, because there was less participation, particularly schools that went from everybody receiving free meals to a traditional model. A lot of students brought their lunches rather than receiving free meals. You had a hybrid of that, yet your participation actually was almost unchanged. I think your lunch program was down about 4% and your breakfast program was only down 1%. So very little change in participation in 2023, which really helped carry the day. Expenditures on page 24 was up, but it was actually not up substantially. It was up about 5%. And if you look at page 25, where were the increases? Well, you saw a little bit of increase in salaries, you saw a little bit of increase in purchased food, and then a little bit of increase in operating expenses and depreciation. But all told, an increase of only 5%. Again, we saw many school districts that had comparable participation have substantial increases in purchased food. And we also saw a lot of schools have substantial increases in salaries and benefits just due to the climate that was in the cafeteria. Okay. So if you look at page 26, yes, sir. Yep.
So the salaries in 19, is that like right before we switched over to what we do now?
Yeah. Yep.
Where we just have like,
The food service director retired in June of 2019.
So you're kind of using, with nutrition, you're using kind of a hybrid model. And we see some schools that use the same model where your management function is really being handled by nutrition and your employees are really employees of the district. I've seen some schools that all employees are the district's, and I've seen some models where all employees are Nutrition Inc. Just, they have different models where they can work out contracts with school districts. Okay. So page 26, you can see the results. Again, prior to the pandemic, 2019-20, break even or a little bit of a loss in 2020. And then ever since the pandemic, you've been doing phenomenally in the cafeteria, where the blue is substantially above the red. In the current year, your surplus was about $217,000. Last year was $237,000. Again, we saw a lot of school districts have a substantial change in 23 versus 22, and most of the time the change was towards the negative. The fact that you were able to maintain status quo from an operational standpoint is pretty darn good. Now, there was good and bad. The cafeteria, the federal government has a lot of restrictions on, how much fund balance you're allowed to have, and, now you have a substantial amount of fund balance, which is great. You can do improvements in the cafeteria, you can buy new equipment, and you're not going to have to utilize the general fund to provide assistance or subsidy for your cafeteria. Okay. And it sounds like in 2023-24, the district's gone completely to a CEP model where all children receive free meals. Again, the reimbursement isn't not necessarily 100% favorable, but again, maybe your participation will climb a little bit even more in 23-24 than it was this year. Okay. So that's it financially. The very last section of our audit on page 29 are just some general comments. One couple comments that I'd like to make are letter C, there's a new GASB. So every year they come up with a GASB. This one's referring to compensated absences, is how we ultimately value the benefits that are received when somebody retires. Currently, school districts are all kind of doing things a little bit differently in their interpretation. This kind of provides specific standards of here's how that compensated absences, accumulated sick time that employees have gets valued within your financial statements. And then lastly, letter D, pandemic grant funding. Basically that comment is twofold. One, we're winding down of all these funding. There were really three tranches. There was ESSER 1, which was the CARES funding. That was back in 2020, 21, and most school districts spent their money during that year. The second tranche was called CARISA or CIRSA. That was ESSER 2 funding. That actually school districts had the ability to spend that through September of 2023. So just a couple months ago, the funding had to be fully expended. And then the very last tranche was the American Rescue Plan, the ARP funding that school districts received. And that has a deadline of September of 2024. So part of our comment is just make sure you have, everything laid out as far as how that funding is going to be spent and through the end of the deadline. And then secondly, the comment says, what are things going to look like when the funding goes away? And, why do we say that? Well, I can tell you, like, every school district has done things a little bit differently with respect to the pandemic funding. Some school districts have utilized a substantial amount of the funding towards existing operations for salaries and benefits that are currently in their structure. And they utilized a lot of that funding towards those expenditures. Other districts, spent it entirely on things that were, maybe improvements to the school or a new curriculum or a new technology program. And then other districts kind of did a hybrid. We also saw like the timing, like some school districts really spent most of the money up front. Some spent it kind of evenly over the 3-year period, and some still have a tremendous amount left to spend, believe it or not. So through June of 23, Wattsburg Area School District had about $500,000 to $600,000 left of American Rescue Plan, and just had a little bit of CIRSA funds that I'm sure you spent through September. And I think overall, most of your expenditures were one-time, things that were not in your existing structure. Okay, so that's great. But still, is there a chance there could be some impact to the district when this funding goes away? And an example might be like, for instance, the summer school program. We've had discussions with schools that said, we thought when we got the funding, we were going to plan out 3 years of summer school, and when the money goes away, we're going to scale back to where we were prior to the pandemic. And they've rolled this program out, and it's done a lot for the kids. And so a lot of schools are like, can we scale it back like we thought we were going to, or are we going to have to continue with the program that we currently have? Same with the after-school program. Some schools have put in robust after-school programs, thinking, we're going to scale that back once the funding goes away, and the community is kind of like, geez, this is an awesome program, and we're dependent on it now. We need that program for our kids. And so, is that a program that we're going to have to continue going forward in our model? And so those are probably some of the discussions that you're going to have maybe over the next year or so, and maybe when you develop the budget for next year. And there are things that we didn't think we'd have to discuss 2 and 3 years ago. So just food for thought. something to chew on a little bit during your discussions in the finance world. Okay? Any questions? Lot to digest. Thank you. Thank you.
Question about the statement of net position.
Yes.
And when you explained about our PSERS is underfunded.
Yep.
We have to represent that in our liabilities as well as the post-employment benefit.
What slide are you on?
Slide I'm on number 7.
Number two.
Okay.
Yeah, I could turn on my mic too. Number 7. So I guess when you explained all that, I was thinking, well, those are things that we as the school board of Wattsburg and Wattsburg School District overall have no control over, how PSERS is funded. So I guess taking that into consideration, is that those are the main impacts on this net position, which is improving. So I guess we're improving, and there's not much we can do to improve anymore, given that those things, unless something changes at the state
Really good
government,
point.
are going away.
It's really a good point. And, the PSERS system, my guess is probably next year it'll show a little bit better because there was a robust market in the 22-23 year. So I would expect that liability to come down a little bit. Their goal is to be at 100%. They don't want to be at 120%, and they don't want to be at 80%. And so, how is it impacting school districts currently? Well, our contribution rate, the contribution that we're making for every salary paid is over 30%. What is it, like 35%? So it's a substantial amount. That being said, a lot of that obligation is actually falling on the state's shoulders because school districts in Pennsylvania actually receive a reimbursement in state aid for a percentage of that contribution that we're making to the pension system. And the reimbursement actually favors new employees versus existing employees. So every time somebody retires and you hire somebody new, you actually receive more reimbursement towards that towards the PSERS system. My guess is your true overall contribution is probably closer to 10 to 15% versus 35%. But that difference is being borne by the state of Pennsylvania along with all the state workers. And so that's, partially crippling the state on providing funding to schools, and that's because there's such a substantial pension system. But yeah, it's a good point. You have no control over that. The other post-employment benefits, part of that is the district's plan. A lot of that's dictated by your local contracts that are, union contracts that are included in the contract. Ultimately, that dollar amount isn't real substantial. We see some school districts, they have a substantial amount of health insurance they're paying for retirees. And that obligation, we've seen, 30, 40, $50 million that are represented in the financial statements. So your $2 million is, it's a big number, but it's not as substantial as we have seen from other schools.
My other question is about the one internal control matter that you've mentioned and has been in previous audits. So I guess I'm curious, my understanding is it's pretty common in districts, especially of our size, that the firm assisting us with preparing the documents is not unusual.
Yeah, very good point. We make that comment very, very, very often within not just our school districts, but our other entities of similar size, particularly how robust this financial statement is. It's a pretty typical comment that we make for school districts.
Thank you.
Yep.
Hearing no other questions? I thank you for your presentation, and thank you to Mrs. Bendig and your team for putting together a great report. So we appreciate it, and thank you for your time tonight.
Thank you.
Thank you.
Appreciate it.
Thank you.
Thank you.
We will be on recess until 7 o'clock, about 8 minutes.